Hello my fellow investors and welcome to yet another research video here from Invest Like a Guru. Today we're gonna take up a topic that can stir some emotions around at the screens, I'm sure. We're gonna have a look at cryptocurrencies and we're gonna have a look at the question, is it really worth it? Now, I know many of you can have a ton of different reasons to invest in cryptocurrencies. It could be the dream of getting rich. It could be the dream of the fiat currency system will collapse and you will be sitting with the cryptocurrencies that are the only viable mean of payment. And it could be a ton of different reasons. Now, as always, we are trying to take a research look at this. We're gonna look at data. We are gonna try to be objective about it. But of course, you're welcome to put your comments in the comment section below if you disagree with us. But let's have a look at what we really mean by this. First of all, if you have been investing in crypto, in this case Bitcoin, you know that it is a volatile monster to dance with. This is, as I said, the Bitcoin. It's on a weekly chart and it's from back the beginning of 2017 and up until today. Now, if you don't think this look like your chart at home, it might be because I have chosen what is called a logarithmic scale here. Now, normally when we are looking at stocks and less fast rises, we're looking at what is called a regular chart here. But when we're looking at things like Bitcoin, where things have gone up with so many percentages, we are seeing here that we cannot really use the chart for anything in the beginning because the latest rise is simply filling up so much of the spectra here for the price. So here you can see that we are having just a quick note here from 10 to 20,000 we have the same distance, and we have the same distance to 30,000 to 40,000 and so on. But with a log scale or logarithmic scale here, like this, we don't have a fixed number between the lines here, but we have a fixed percentage, meaning that from 1,000 to 2,000 we see the exact same distance as from 2,000 to 4,000, and again to 8,000, again to 16,000 and so on, meaning that 100% rise here is taking up the same part of the chart as 100% rise here. I hope that makes sense. So that is why the Bitcoin chart looks as it does. Now, in our look for data here, we have gone back to the beginning of 2017. We could have gone back further, but we wanted to take some different time periods. First of all, from the beginning of 2017 and up to the end of almost end of 18 here, we saw more than 2,000% rise in Bitcoin. So we wanted to get this bull market within the data to be fair. But we also wanted the big drops here of 83%. After that came another big bull run here at 340%. We had another drop of 70% and so on and so forth. That is the nature of cryptos. No matter if you're looking at Bitcoin, Ethereum, Litecoin, Dogecoin, whatever, Ripple, you can name whatever you want. We see pretty much the same volatility picture. So that is the nature of this beast called cryptocurrencies. Now, what have we done then? Well, we have picked a lot of data. And as you can see here, it might look a bit boring, but here we have the names of different cryptos. Sorry, this was not all cryptos. We have them here. Bitcoin, Ethereum. The one in dark are the one we have picked because that were the ones we have the most data on. Bitcoin, Ethereum, Ripple, Dogecoin, and Litecoin here. We could have picked Dash and Tether as well. But these are the 5 we have picked for our data. They were quite a good picture for the overall crypto market. Now, what you can see here is that from the beginning of 2017 and up until today, or yesterday actually, we have a number of periods. We have a total return, and for Bitcoin it is more than 3,400%. Ethereum is almost 29,000%. Ripple is 9,200 here. Dogecoin is 66,500%. and Litecoin is 2,300%. And now you might wonder, my first question in the beginning, is it worth it? You might ask yourself, now how could this not be worth it with all the percentage gains here? And I'll get back to that in a second. First of all, we have taken these numbers and we have made them into CAGR numbers, that is compound annual growth rate. So for Bitcoin, from the starting date until yesterday, for Bitcoin to reach 3,435% gain, it would need to go up by 102.1% each year, that is the annual growth rate, and compounding the 102.1% each year will add up to 3,435.5. The same with Ethereum, it has a CAGR of 206, Ripple 144, Dogecoin 260, and Litecoin 87. Now these are some good numbers. Who wouldn't want to get 100 or 200% each and every year on average on their investments? I would for sure. However, we also need to consider the so-called volatility, because the volatility or the volatility adjusted return is what we can actually use for something here. And let me just give you a picture of volatility. Now, the volatility is important because let's take two different portfolios. We have one that goes from 0 to up to 20% in a year, and we have one that goes from 0 but only up 10% in a year. Now, if I ask you, which of these portfolios would you rather like to put your money in? Most people would say, well, of course, the 20% portfolio. All right, so far so good. But what if the 20% portfolio got to 20% with swings like this? Meaning that in any given time, you might be up 50%, down 40%, and so on and so forth, meaning that you would never really be sure on how much money you could withdraw from your account at any given time. This is what is called high volatility. Now, on the other hand, we have the 10% portfolio, and it might only be up and down by 2 or 3% all the time, meaning that the equity line, the graph of the portfolio, would be extremely linear, and you could at all time count on being able to withdraw most of your money because you would never have a 30, 40, 50% drawdown. Now that is the important difference, because what we can do here is we can say, all right, we do like the 20% gain, and at any given time we might be down 50%. With the 10% portfolio here, you might say, yeah, well, I'm pretty sure this is not moving much. So what I can do is I can apply some leverage, meaning I can borrow some outside money from my broker, from my bank. And if this one is down at any given time, max 5%, this is down 50%, then I can actually, in theory at least, leverage this one 10 times. Because when leveraging this 10 times, I would get some max drawdowns as well of 50% once in a while, but I would also get 10% times 5. So this one is actually a better return, because if I wanted the same sort of volatility as I did here, I could get a lot higher return because of the low volatility, meaning it allowed me to apply leverage. I hope that makes sense. Otherwise, please drop the questions in the comment section below. That is the volatility part. So looking at the numbers here, we can see that there is a very high degree of volatility. Now, the volatility calculation is a bit complex, so I'll not bore you with that here. But as you can see, there's a volatility of 80, 107, 163, 223, and 119. These are huge numbers. Huge numbers. So when we look at the portfolio results here, you could see that the CAGR, the average CAGR for all of the 5 cryptos is an average of 160% per year in CAGR. Now, I would definitely want that in my portfolio. However, it also has an average volatility on the 5 cryptos of 139%, and that is insanely high. So the question is, can we do better, or can we do something smarter? And now here I will take a look at an ETF called QQQ. Now you might not know it, but let me just introduce it to you here. This is the ETF.com website. It's a free website where you can search pretty much any ETFs in the market. The QQQ is an ETF, an exchange traded fund. And what it does is that it kinds of tracks the NASDAQ 100. It doesn't do it exactly, but as you can see here, the fund description, QQQ tracks a modified market cap weighted index of NASDAQ 100 listed stocks. So it is choosing from the NASDAQ 100 stocks, meaning primarily tech. It is non-financial stocks. You can see some more fact sheets about it down here. But if we go down, have a look at some stocks in the portfolio. First of all, you can see the QQQ here. You can see 1 month, 3 month, year to date, and so on. In the short run, it might deviate a bit. You can see around -5% for the month here, whereas the NASDAQ 100 is around the -9.66. We can also see the actual QQQ here is a lot closer to, so they are mirroring the NASDAQ 100 quite closely. You can see that on year to date, on 1 year, 3 year, 5 year, and 10 year, it is very close to the NASDAQ 100. Now, I know what you will be saying now, because you're saying, yeah, well, over 10-year time period, it is only making 20.5% per year here. So why would I choose an ETF, QQQ, over some cryptos that is delivering a CAGR of 160%? I will get to that in a second. Let me just show you, firstly, some of the stocks that are in here. The stocks that you will, the 52% of the entire ETF is these 10 holdings here. We have Apple, Microsoft, Amazon, the Meta platform, the old Facebook, Tesla, Nvidia, 2 Google stocks, a Cisco, and an Adobe. So these are the huge income producing companies that you will be owning a part of if you own this ETF. Now let's get back to the numbers, because looking at the QQQ, you can see that this one only has a CAGR of 23.8% over the last 1,273 days. Now, the reason why this is 1,273 and we are picking 849 here with the cryptos is that the cryptos are traded during the weekend, whereas the stocks and ETFs are only trading in the Monday to Friday range. So this is the same time span over 5 years. The ETFs, the cryptos just have more trading days. All right. As you can see, there is a CAGR of 23.8%, but there's only a volatility of 22.4, which is actually still rather high, but it is nothing compared to the volatility out here with the average crypto volatility of 139%. So what we can see here is that the cryptos has a volatility of 6.2 times the volatility of the cryptos, meaning the QQQ has a volatility of 22.4%, whereas the cryptos has an average of 160%. Now, if we time this by 6.2, we are getting the exact same volatility, but we are getting some very good returns as well. Because if we are timing the CAGR of the QQQ by 6.2, we are actually getting 147.7% in CAGR. What this comes down to is that if you are interested in taking on this kind of risk, this kind of volatility risk, as you see in the cryptos, if you're interested in taking on that kind of volatility, you could take on the same volatility by buying an ETF and then using a lot of leverage. I am by no means recommending taking on a 6.2 times leverage on a QQQ ETF. That is not what this is about. But what I am saying is that if you want to compare the QQQ, the tech ETF, if you want to compare that to the crypto, you need to leverage up so you get the same sort of volatility. So if you do that, if you times it by 6.2, you're actually getting a CAGR, a compound annual growth rate of your QQQ investments at 147%. I know that is a bit less than the 160%. So if you're only looking at the hard cold numbers over these 5 years, then yes, Bitcoin, Ethereum, so on, these 5 cryptos, they will give you a better compound annual growth rate. That will give you on average 13% extra per year. However, if you're taking some extra considerations here about will cryptos still be here in 10 years? I know many of you will say, yes, of course they will. But then again, it is quite a new phenomenon. And who owns it? Where is it? Can a country, can they make it illegal? All of these issues we'll touch on in upcoming videos in the upcoming weeks here. But it's just to say that the crypto space, there can be a lot of reasons to invest in that. The decentralized financial systems, the collapse of the fiat currencies and so on. You can have 100 reasons for that. And if you're looking at it with cold, hard numbers, it is a little bit better than just the QQQ, the ETF, when you're looking at a volatility adjusted return. But if you're looking at the ETF and saying, yes, I would like 147% a year to get the same volatility as in a crypto portfolio, but on the other hand, I am actually owning a ton of high-end stocks, some of the best income producing stocks that will probably not disappear tomorrow or in a year or in 10 years, or at least they have been around, these major stocks, for several decades. Some of them have been around here for 50 years. So if you would rather own some of the best, most trusted companies in the world, that most of them are producing a profit, you could do that and you could get almost the same return as spreading out over 5 cryptos, again, if you're willing to take on a lot of volatility risk. Now, I would never do this myself, and as I said, I would not recommend anyone doing this. But we have tried to put these figures together to compare these so that if you are considering cryptos and you have fallen in love with the insane numbers, in KGAR numbers here, then know that if you have, let's say, $100,000 and you went out and borrowed 600,000 more, 600,000 more in the bank and put into your trading account and just bought the QQQ, then you would actually get almost the same return, but you would own real stocks, or you would own an ETF that owned real stocks, which a lot of people would prefer. I should not be the judge if you should do one or the other. As I said, I would never recommend doing a 6 times leverage account here, but I should not judge if you should choose the crypto-based portfolio or the ETF and stock-based portfolio. But we have tried to put the numbers side by side here so you can see that there is actually not the huge difference that some people make it to be. I hope this made sense. As I said, you're welcome to put some questions or comments in the section below. If you have other reasons to buy crypto than just the great KGAR, you can also write them below. And if you like this channel, please remember to subscribe. YouTube really like these subscribing viewers, so you will be shown more of our videos next time you log into YouTube. That's all for now. Take care of yourself and your money out there, and I'll talk to you again with more crypto, system, algorithm, and stock-based videos in the future. Bye for now.